Hi, everyone, and thanks for joining us. My name is Rafia Hasan. I am Chief Investment Officer for Wipfli Financial. Before we get started, I wanted to cover a few quick housekeeping items for today's program. All participants are going to be muted, but you'll still have the ability to access the chat box, which can be found in the menu bar of your Zoom window. You should press more if you don't see it. We welcome you to submit questions through the chat box. Any questions that we can't get to will be addressed directly by a Wipfli financial advisor after the event. So we've had an extremely interesting start to the year in financial markets. There's been no dearth of news to talk about. It has been a little bit of a rocky start to the year, and that's true both on the stock market side of things as well as the bond market. And so we wanted to talk to you today about our mid-year outlook, and I'm joined today with a guest speaker, Brad Long. Brad is a partner and Deputy Chief Investment Officer at Fiducient Advisors, and Fiducient is an investment consulting firm with over 260 billion of assets under advisement. So we're really fortunate to have Brad Long with us today to talk about the outlook for the rest of the year, given the really, I'll say, volatile and interesting market environment we've had so far. So welcome, Brad.
Appreciate it. Thanks for having me.
All right, great. So let's get started. Kind of big picture, what's your outlook for the US and the global economy?
Yeah, there's no question that the economies, whether it's US or globally, are slowing. Part of that is just contextually where we're coming from. 2021 was a great economic expansionary year coming out of vaccines in 2020, the proverbial doors swinging open on economies. And, we've seen a lot of economic growth in 2021, especially we saw that towards the tail end of 21 as a number of businesses, were kind of purchasing up inventory, which we'll talk about in a moment. So part of that is in 2022, we've been slowing because we've been coming off somewhat of a torrent pace. But nonetheless, we are slowing in a number of other ways. If you look at the main drivers of economic growth, it's the consumer, it's monetary policy and fiscal policy. The consumer remains strong but weakening, and we can talk about that in just a moment. On the fiscal side, there's really not much to talk about. We were very accommodative through 2020 and into 2021. But given one, we're at a mid-year election, and two, we're really not in a spot where the central governments can be doing a lot from a stimulative perspective because of the current pace of inflation. So we're pretty quiet on the home front when it comes to fiscal stimulus. And then in the monetary front, I think most people know we're very much in a tightening regime, so trying to slow the economy. The Fed has raised rates 3 times by 1/4 of 1% or 3/4 of 1% in total. And just last week, we started quantitative tightening. So we are slowing, and we expect to continue to slow. I think the question is the total rate of slowing and whether we kind of move into what is more of a recessionary environment. But to some degree, that's actually what the Fed wants. They want to be slowing the economies because they're trying to slow inflation. They're just trying to do so in kind of that soft landing manner, and we'll see if they can get there.
So talking about, you talked about slowing of the economy and cooling down. I think one of the questions that is on everyone's minds today is, is there going to be a recession? And, would you recommend making any changes to an investment portfolio in anticipation of that?
So we certainly do not have a crystal ball on recessions. No one does. There's no question that the likelihood of a recession is rising, right? As the economy is slowing, anytime that's happening, the likelihood of kind of dipping in a recession is a technical 2 quarters of a negative GDP print. So that the probability of that is rising, and we actually had a negative print in Q1, right, somewhat for a technical reason on imbalance of payments, and not to get into too much of the detail. But nonetheless, we are kind of moving into a slowing environment, and it seems like May has been the month of recession obsession, I guess you could call it, trying to figure out and read the tea leaves if we're going to be moving or falling into a recession. The 2 points we would make there, and kind of your key point, Rafi, on should we be doing something about it? So one, by the time it becomes evident that we are in a recession, it's kind of the horse has left the barn. It's too late to make a move there. And markets are anticipatory of economic weakening and potential weakening in markets. And so markets are already down this year. Obviously, fixed income for somewhat of a different reason, but equity markets somewhat in sympathy for the probability rising of entering a recessionary environment. So at this point, with volatility picking up and markets already down, now is not the time to change the game plan. If we were worried about portfolio positioning, right, a conversation in 2021 or truly in preparatory of that could make sense. But now is certainly not the time to be making changes, even if we think the odds are kind of shifting in one direction or the other, because the portfolios that we've designed are really designed with recessions in mind. Recessions are a normal part of economic kind of expansion and contraction. And so when we're building portfolios, we know that they happen. And now is not any different in that regard. So is now the time to change? We would say it probably not.
Yeah, and I think that's a really important point that you make, that markets tend to lead the economy when it comes to changes that are taking place, whether that be recession or anything else. Markets tend to be a leading indicator of the economy, and so a lot of times, that bad news is already priced into where the market is at. And so trying to time those types of things is extremely difficult. And when we zoom out and look at markets over a longer time frame, just as you said, markets have had a positive expected return over time, and that includes many recessionary time periods. And so it's very difficult to make those changes to the portfolio in anticipation of that. And by the time you find out that you're actually in a recessionary period, and when the National Bureau of Economic Research says, okay, we were in a recession from this date until this date, the recession has already passed. And I think that happened even the most recent economic recession that we had in through the pandemic, right? It's like,
yeah,
that you were in a recession after the fact, and we were already out of it by the time it was dated.
The only other point I would make is, recently investors have been trained to think of recessions as these really big blowout events. So COVID was unprecedented in modern economic times. Before that, we have the global financial crisis or the great financial crisis, depending on what you call it. Before that, we had kind of the sweep out of technology in 1999 and 2000, 2001. But recessions in history don't have to be these market driving down 50% events. Actually, the last time we had similar economic conditions of slowing in economic environment and an inflationary point was in the late 1970s or early 80s. And while we actually entered two recessions in the early 1980s, markets weren't extremely volatile like we've come to learn recently. So it is important to think of, don't just apply yesterday's recession to tomorrow's, even if we do move in that direction, because it doesn't necessarily mean we're going to go kind of through the exact same experience.
Yeah, so on your point regarding kind of some of that elevated market volatility that we've seen this year, how normal is the volatility that we're seeing this year? Is this abnormal? Is this kind of par for the course? What are your thoughts on that?
So in any given calendar year on the S&P 500 since 1980, the average drawdown is about 9.5%. So that's not a correction, which is 10% or more. That's not a bear market, which is 20% or more. But if you just think about since 1980, the market at one point pulled back about 10%. So volatility is just a normal part of markets. But kind of that sub 10% volatility is probably garden variety volatility, if you will. The 10 to 20% volatility, that's also fairly normal. It happens about every 2.5 to 3 years, where you'll see some kind of more meaningful pullback. We saw many of those in the expansionary period between kind of the GFC following 2008 and the actual recession and drawback that we saw in early 2020 due to COVID. And there was a whole myriad of reasons, right? It was the Fed increasing interest rates. It was the S&P was downgraded, from AAA status and a whole host of others. So the volatility, if we just take a snapshot of where we are today, that's also fairly expected. Now, when we get into down 20% or more, or even when you get into bigger figures, That happens about every 10 years or so. So not unprecedented, but certainly less common. But again, if we think about what kind of foundation does market volatility or recessions, what do those lay the base of? Well, they lay the base of future economic growth, future opportunity, and also one of the reasons we build portfolios in the way that we do, right, with diversification and kind of thoughtfulness and mindfulness in the way that we construct, because we know that these things happen on average. So while volatility is uncomfortable, it's not uncommon. And we're not all that surprised by the volatility we've seen in the market year to date.
Yeah, thanks for that perspective. Let's shift gears a bit and talk about something that I think has probably been the most obsessed over, I would say, after potentially recession in the month of May. But I think this obsession has been, longer standing, which is inflation. What signs are you looking at to see if inflation is beginning to abate? What is your outlook for inflation?
Yeah, it has definitely been an obsession. And it's funny because inflation had really fallen out of the nomenclature or the lexicon of investors for many, many years, really dating back to the mid 1980s before it was a material factor. And so it was almost forgotten about. Inflation, whether we saw peak inflation in March of 2022, it seems probable, but we don't know. I would say there's a couple of things that do point to abating inflation. One is just what's actually called the base effect. So if you think about just the math of inflation, if something costs $100 and then inflation's up 10%, that widget now costs $110. But to be up another 10% from 110, it actually has to be up $11, right? So it's difficult to continue to increase at the same rate over time. And so as prices have risen, the likelihood that we'll continue at a really high clip and rate of growth is falling. So that's just kind of the math of inflation. Now, that doesn't necessarily mean goods are getting cheaper. It just means they're not increasing at the same rate or getting more expensive as fast. Now, there are certain parts of the market that have cooled. The kind of classic one that we were talking about in 2021 was used cars. That was such an anomalous thing in which rental car companies were trying to restock their fleet. Semi-chip conductors had low supply, so new cars were really coming on the line. So all of a sudden, everyone is buying used cars at the same time, and they were up over 50% in 2021. They're down in the last year since, right? So there are some of these things that are transitory, but when we start to pick apart the components of inflation, the largest single component of inflation is housing. Housing prices have been in aggregate rising, but they're doing so at a slower pace. Part of that is higher interest rates mean higher mortgage costs, which means prices may be under pressure. There's been less houses coming to market. So, housing has slowed a bit. And there are a number of other things when we look at something like container prices. So whether that's shipping goods on marine vessels across the sea, or even trucking prices. Actually, 78% of finished goods in the United States are shipped in trucks. And we can actually see trucking rates slowing a bit. So there are, if you start to read the tea leaves, signs that inflation is either has peaked or at least is slowing. But what we would caution to say is just because inflation starts to slow doesn't mean that we're going back to straight down to the 2% rate that we enjoyed for 30 years. It's likely that inflation will remain somewhat elevated, but those are for bigger, larger secular issues, which we can talk about kind of on regionalization versus globalization or supply chain dynamics and other things that kind of drive the price of goods. Now, the one spot that's really not slowing at a material rate has been wages in the employment industry. There's still about two openings per job-seeking employees out there, just under. And so the labor market remains tight. And I think that's one of the things the Fed is definitely watching when they think about how much do we have to increase and what do we have to do to actually slow inflation in a material way.
Yeah, I think one of the interesting things to see in the last jobs report that we got on Friday was that the pace of that average hourly earnings, the pace of the growth of the average hourly earnings was coming down a bit. Now, still increased by a little bit over 5%, but it does seem to be moderating. So potentially there could be some signs that the Fed kind of starting to Fed action starting to have an impact on cooling down the economy. But you're absolutely right there that that the labor market is still very tight. One of the other things that you didn't comment on was the energy side of things and how that could impact inflation. Can you talk a little bit about that?
Yeah, energy, commodities, agriculture are obviously important parts of inflation figures and just how we consume goods. Gasoline is clearly one that the average consumer focuses on quite a bit. For the first time ever, we had some natural gas prices above $6 per gallon. If you think about, again, kind of that base effect, right? Oil started the year in the mid 70s, rose to kind of I think it was 127 when Russia invaded Ukraine, and subsequently fell and has risen back up a bit. The likelihood of energy or other industrial metals, or I'll hold aside agriculture for a moment, but the likelihood of that kind of repeating again next year and being up, oil at $200, it's possible, but it's not likely. One of the things that is said over time is the cure to, high oil prices is high oil prices, meaning more consumers step in or more producers step into the market. We saw Saudi Arabia recently showing a willingness to produce more. Baker Hughes data, which is US wells data, has actually started to increase for the first time in the last couple of years. So you can see more supply come online. Now, oil is one of those geopolitical prices, which will go up and down based on volatility and conflict. So you could see volatility in the price, but the likelihood that we'll have another kind of exponential growth in price is lower. Now, agriculture was one that we held aside. One, there's still a lot of geopolitical risk in agriculture and shipping and exports, and part of that is kind of driven by Russia and Ukraine. And then there's also just the natural ebb and flow of agriculture and what's coming on from supply, from crop yields, et cetera. Unfortunately, that's been a harder place because it's one of the most regressive inflations, where individuals with the least amount of money really have to prioritize food and shelter. And as food costs are rising, it's going to impact them more. And that is one that's been a stickier area, but it does tend to be a volatile area over time.
Yeah. So talking about some of those geopolitical concerns that have been forefront for markets, and one of the concepts that I've seen come up more is around reshoring, and how could reshoring end up impacting inflation, and what impact could that have even potentially on global economic growth? Any thoughts that you can share with us around that?
It's a really interesting topic and one we've been spending more time on. So when we talk about reshoring, we actually talk about it from a globalization versus regionalization. So we zoom out a little bit. Since kind of the late 1980s, we've been in this globalized economy, right? So in theory, the idea is find wherever in the world, who can produce the best and the cheapest widget, and then that country or that city will produce, or manufacturer will produce that widget, and then you can spend the time on the things that you're best at. And in theory, that produces a more robust global economic output and can keep inflation low. And perhaps it has since the 1980s. Two things that are driving against that today. One is this idea of kind of the West and the East. So think of China really being the central point of the East, and EU or NATO being the central point of the West. There's explicit tariffs that are growing there. There's tensions that are growing there. And obviously China has been, for many years, for decades, trying to position themselves as kind of the epicenter of the global economy, kind of the re-envisioning of the Silk Road. And that is driving kind of a division between East and West. Ironically, Russia's invasion of Ukraine has united kind of the proverbial West, Japan, EU, and the United States in a way we haven't really seen since the Cold War. And so that division is somewhat growing. Now, the practical impact of that from an economic perspective is, you can have more tariffs, which is greater cost of goods, lower free flowing goods across borders. The practical impact there as well is kind of the cost to the individual consumer. Prices could rise as a result. And then not just on the East-West or the reshoring, but many businesses really learned that through COVID, the idea of having a single manufacturer of which you are dependent upon is a difficult proposition and can put your business at risk. And so it could be reshoring, where you're thinking about literally a geographically closer supplier, or multiple suppliers. So if you're in the United States, you could have a supplier in China, and you can have a supplier in Mexico. And the resiliency is better, but the cost is going to be higher. So either businesses will shrink margins because they'll eat the cost, or they'll pass it on to consumers. And if we know history is a precedent, it's likely they'll be passing it on to consumers. So that could put somewhat of a floor under inflation. And again, kind of getting back to the thesis of, even if inflation comes down, it may not come down straight down to that 1 to 2, sub 2.5% range we've come to expect.
So related to that, how do you think about international exposure within a portfolio? And then also, given the conflict between Russia and Ukraine, does it make sense to pull back at all on international exposure, given some of these themes that we're seeing with potential reshoring and some of those changes that could be on the horizon?
Yeah. Russia invading Ukraine, obviously it's a horrible humanitarian outcome, and trying to kind of hold that aside to some degree, just speaking on the economic and market perspective, Europe is clearly the most impacted. Other than, Ukraine is the most impacted. Russia, has somewhat shot themselves in the foot, pardon the pun, around their recent actions, and their economy has been hurt badly. But the EU has definitely been impacted, no question. Germany in particular, it's a manufacturing-based economy, heavily reliant upon natural gas from Russia. They have the Nord Stream 2 pipeline that literally goes under the Baltic Sea and straight to Germany and provides cheap power for their manufacturing-based economy. So there are pockets that have been felt. But if we try to step back for just a moment and think about Russia's actions in Europe, they have probably done more for the resiliency and long-term outcomes for the global economy than they've hurt it. And what I mean by that is Russia's actions in Ukraine are somewhat could be thought of similar to China's interests in Taiwan. And while very different motives and histories, if we were to simply just replace the story and say China forcibly invades Taiwan rather than Russia forcibly invades Ukraine, and apply the exact same set of circumstances, sanctions, et cetera, Russia's impact on the global economy is minuscule compared to China's. And so Russia's done more to prevent China from taking similar actions than they have almost anything else. And that's probably a better and a steadier foundation for global economic growth and opportunity, especially outside of the United States. So when we think about the unfortunate nature and the direct impact on Europe, we actually think, if just taking a longer term view, it probably sets a steadier hand for the world's second largest economy, which is China, and their potential impacts across various regions. So it's not a time that we would be materially rethinking our exposure based on kind of this action. And most of our exposure there is really based on opportunity and outlook. And to some degrees, those have improved modestly.
Right. I think one of the interesting things, obviously, with the conflict and all the headlines that you're reading, it's easy to, not focus as much on the pure numbers, but on a year-to-date basis, actually, international and emerging markets, while they're still down, they're not down by as much as U.S. markets, and that's one of the interesting things that we're definitely talking to with clients about. Is yes, there's you can have that understanding that, hey, what's going on in Russia and Ukraine might have a greater impact from an economic standpoint on Europe and potentially emerging markets, but how the financial markets and the stock market ends up behaving, that can be a little bit divorced from that reality, obviously, also because there's different companies that make up those indexes and the stock market necessarily than what's going on in the broader economy at times. So those are some of the things that we've also been talking about. I think another interesting point to make is with regard to relative valuations and where valuations stand with international markets relative to US markets. And I know this is something that, we've also talked about with Fiducient in the past, and what the outlook is just given from a valuation standpoint. Any thoughts that you have to share around that?
Yeah, the US is certainly trading, and has, by the way, for a long period of time, traded at a premium compared to developed international or emerging markets. Compared to historical averages, say like price to earnings metrics, the US is kind of on average, right? It's not cheap, it's not expensive. It's certainly less expensive than it was at the start of the year. But if you look relative to international markets or emerging markets, they're not only cheap relative to the US, they're cheap relative to their own history. And there's a number of interesting opportunities across those great companies, economic dynamics that can add value over time. And so when we think of the opportunity outside of the US, it still remains rich, right? The US is the largest economy and the largest market, but it's certainly not where the world doesn't start and stop with the, Californian and New York border. And so there's lots of opportunity outside of our borders, and I think continue to do so. The final thing is, in the last decade, right, the US dollar has been strong relative to many currencies, and that the effect of that is it's a headwind to anything you own outside of the United States. With the United States and our current inflation rates, when you're thinking about the balance of payments and currencies, there could be an opportunity where the dollar's strength could slow or even weaken, and that you don't have to rely on that as a opportunity for outside of the United States, but it might take a headwind to at least indifferent, or maybe even become a tailwind. And so that's another opportunity that, as we think about trying to just simply look at the past to predict the future, we don't think is necessarily instructive. But if we look at relative valuations and potential future opportunities, that there remains opportunity outside of the US borders.
All right, let's switch gears a bit and talk about fixed income, because certainly that's been something that has been more unusual that we've seen this year, is that at the same time as stock markets are down, bonds are also down. Given the Federal Reserve's hawkish policy, the fact that there's probably more rate hikes yet this year, and maybe even potentially in 2023, does it still make sense to have exposure to bonds?
Yeah, it's a great question. And I certainly appreciate kind of where investors feel like, wow, it is different this time. Like, what happened to fixed income here? And to some degree, while not unprecedented, certainly uncommon to see broad fixed income, so like the Bloomberg aggregate and the S&P 500 fall at the same time and kind of to the same degree. That's not, again, not unprecedented. The late 19 or early 1980s, we saw a similar time period in which they both fell in a similar magnitude, maybe coincidentally or not, right? And also a period of higher inflation, rising interest rates, et cetera. So we're cognizant of that. But if you step out and you think, one, Rafia, to your point, the Fed is likely to continue to increase interest rates from here. That's true. So we've only had 3 interest rate hikes of 1/4%, so 0.75%. Fed futures, which is certainly no guarantee, but it's the market's best guess on what the Fed is going to do. If they're correct, we would actually end the year at 2.75% to 3% on the Fed funds rate. So that means we would have 8 more Fed rate hikes between now and year end. And again, there's absolutely no guarantee that would happen. That does not mean we have 8 times the amount of pain ahead of us, right? Markets, to your point earlier, markets are discounting mechanisms. They try to look into the future and understand, and they know that the Fed is kind of stuck between a rock and a hard place of having slowing economic growth and rising inflation, but they're prioritizing cooling inflation. And so much of that pain can already be felt in fixed income year to date. So I just want to set the notion that just because if the Fed continues to raise, while that's not necessarily helpful for fixed income, it doesn't necessarily mean that we're going to have a repeat of the first quarter. But the thing I would also take from there is, why do we own fixed income in the first place? Well, we own it for diversification purposes. We own it for income, and we own it for periods and kind of material drawdowns. And I appreciate that the first quarter hasn't felt like that. But if we were to say something like, we talked about the R word, recession. If we were to enter a recession and the markets sold off materially, you could easily paint a picture in which the Fed pauses increasing interest rates, fixed income could rally, that could help protect portfolios, right? So the idea of if we had perfect information, we would only own one asset, right? We would just have one thing in our portfolio. Well, we don't have perfect information. And actually, we're at a period of fairly wide outcomes, right? A soft landing or a recession. And so fixed income is still an important asset in our portfolio because it can help buoy against some of those environments. And then finally, the outlook for fixed income today is way better than it's been over the last couple of years, because the best predictor of future return for fixed income is current yields, and current yields are much higher than they once were. So while painful to get there, looking through the windshield, not the rear view mirror, the outlook for fixed income is brighter than it once was.
Yeah, I think that's a really important point that you made there, Brad, just in terms of, even though there's 8 potential rate hikes on the horizon, that doesn't necessarily mean that we're going to see 8 times the negative returns that we saw in the first quarter. I think one of the other interesting things to note is just how, rising federal funds rate doesn't necessarily mean that yields across all parts of the curve are going to go up. And so there's also that correlation that sometimes, investors or market people who are watching the market might be making that isn't necessary for the longer end of the yield curve. It's more the supply and demand dynamics that are going to dictate where yields are at. And then certainly when you're looking out at, longer term expectations for inflation, they are more anchored than what we're seeing for maybe the 1-year look ahead. And so given that as well, for like a 10-year treasury yield or what have you, that the chances that that's going to go up, as much as it has over the past, let's call it 4 or 5 months, by as much in the latter half of the year is probably lower. That probability is probably lower on a go forward basis.
Yeah, and to your point, break-even inflation, which is the market's bet on inflation in the future, on a 5-year basis and on a 10-year basis, has actually fallen recently. So right. The market is saying, hey, we think we have reached peak. We do think it's transitory, and lower inflation or more modest inflation is definitely beneficial for fixed income. So I think your point is spot on, Rafia. There's an oversimplification of Fed interest rates and what happens across all fixed income. It's certainly important, don't get us wrong, but it's not ubiquitous everywhere across the yield curve or different types of fixed income assets.
Yeah, and I think the other thing that I would mention there is also just having diversification even within your bond portfolio is really important. And then having exposure to active fixed income managers that are picking their spots in terms of where they want to be positioned from a sector standpoint, and also points along the yield curve to be able to maximize return can be very helpful in the environment that we're in right now. Okay, so another kind of shifting of gears, let's talk a little bit about midterm elections. That's not something that people are talking about as much right now, and how that might end up impacting the market. I think there's other things that have been consuming people's energy, but those they're going to be coming up quick, I think, and then that's all going to be all everyone can talk about. What are your thoughts on the midterm election? How could that end up impacting the stock market?
So election and election cycles and results, kind of similar to the economy and the market, right? They're related, but they're not necessarily predictive, right? So one party being in the White House or head of the judicial branch or the Senate or the House is not predictive of a better market or a worse market. So trying to think about kind of blue versus red in outcomes is not really a recipe for success. Now, historically, interestingly enough, midterm election years don't tend to be particularly good years for markets. There's a little bit of data mining in that, right? Because there's many other things that are happening with outside of the election cycle than just the election cycle and market returns. But as we read that information, we really think about it as markets fundamentally dislike uncertainty. And when you think about general elections or midterm elections, they are a period of greater uncertainty. And so, you might have kind of shifting policies across houses. Now, years following midterm elections actually tend to be statistically a little bit better. And the reason is oftentimes the controlling executive branch has more often than not lost control of either the House or the Senate if they previously had control of it. So they had, more of a free runway to make change. And what, as we look at that information, we really think about it as when you have somewhat of a divided House, and I don't mean the division between parties, but balance between executive branch and legislative branch, you have a less likelihood of sweeping changes that could materially influence markets. Major tax reform, major overhaul, major sweeping legislation like Build Back Better, or PPP, or something like that. And so, while midterm elections, there is kind of some noise around that, and I'm sure we'll see more of it as we get closer to the November timeframe. It's not something we necessarily trade on or do anything about, but be cognizant of. And it's worthy to watch, but I think as we've seen some volatility or conversation around it, probably treat it more like noise rather than like a predictive element of what we should think going forward.
Yeah, and that's certainly how we're thinking about it. Like you said, there's a lot of noise around elections, and so trying to use that as a signal to time the market, as any signal to time the market, just generally doesn't seem to work very well. So another kind of question that we have is around earnings expectations for the second half of 2022 and beyond. We've talked about a little bit of cooling potentially when it comes to the economy. What is the outlook for earnings?
Earnings is one of the areas where we think if we're going to see more volatility in the second half of the year, that it's probably going to come around earnings. If you think about revenue, revenue has actually been in a good spot. The consumer has been spending, revenue has been growing. We recently closed out the first quarter in the United States for the S&P on earnings, and revenue actually grew 13.6%, which is the fourth largest revenue increase in a quarter since FactSet started collecting that data since 2008. So revenue isn't the problem. Now earnings, so revenue is basically sales, right? How much you take in, and then you've got costs, and what you're left with is earnings. That's an oversimplification, but it's directionally correct. Now, earnings this year, we had fairly high expectations, and in Q1, 77% of companies on the S&P 500 beat their earnings expectations, and we had earnings growth of 9.1%. So both of those are healthy and are basically supportive of a rising market. Now, if you look at earnings expectations today for the full calendar year of 2022, we're actually expecting earnings to be up 10%, which means in the second half of the year, we need earnings in the second half of the year to be up around 11% to make up for that somewhat, undershot on Q1. The likelihood of that, in our opinion, seems to be falling. So we've seen a lot of recent earnings reports in which companies are giving negative guidance. Part of it is increasing costs. So they have to pay employees more. We were talking about wages earlier. That's a big part of net earnings. And so the cost of doing business is rising. Supply chain has been an issue, whether it's just procuring products. So think of new car sales. It's hard to find a new car. Well, if you don't have cars to sell, you're not selling cars, right? And so that impacts earnings. So the likelihood of meeting kind of fairly robust expectations are falling, in our opinion. And the market's been trading around that. You can see a whole host of recent examples from February on for Q1. Meta, which is now what Facebook calls itself, missed earnings. It was down 20+%. Target, same thing. Walmart, similar things. Netflix, subscriber growth fell, and the company was down materially on the day. And so there's a likely that as reality starts to set in on the ability to meet somewhat high expectations, there could be volatility around some of these stocks. Now, the cousin to volatility is opportunity, right? It doesn't necessarily mean the market's going to fall from that, but it does mean that we're probably going to have to reset some of our expectations of how we entered the year. And we're even seeing that already in Q2 expectations, which have fallen pretty considerably, but the whole year, or Q3 and Q4, have been slow to react.
Yeah, so I think we have time just for one last question for you, Brad. And this one, I'm going to focus more around sentiment. Consumer sentiment is very low right now. Are there any silver linings, would you say, in the current market environment? There's so much uncertainty out there. Like, what do you see as potential silver linings?
Yeah, the sentiment it's interesting as a gauge of kind of consumer confidence, and there's a lot of different versions of sentiment. Rafia, you wrote a great piece recently, and you highlighted some of these points. The old adage of be fearful when people are greedy and be greedy when people are fearful, that basically says when everybody knows that the markets are going to fall and everybody has an opinion that things are only going to get worse, those are generally interesting points to become an investor, to be a buyer. The inverse is true, right? When you're in a cab and someone's saying, here's my stock picks, right? And the markets are only going to go up. Those tend to be fairly poor times to be an investor. And sentiment is fairly low today. And so when sentiment kind of troughs, right, is low, forward returns are materially higher than when sentiment peaks. So that speaks to kind of the opportunity here of, yes, there are certainly things ahead of us, like earnings, like some of the geopolitical risk, midterm elections, but I think all of that is creating somewhat of that anxiety. And again, if you take a longer term approach, generally being an investor in those periods of time is a good thing. At the very least, not getting caught up in the hype and kind of being a seller into volatility and making emotional decisions at wrong periods of time. Those are the things that can really have material detriment to returns. But on the offensive side, kind of being greedy when others are fearful, it tends to be a fairly good time. And so that is definitely a silver lining here today, because sentiment is fairly low.
All right. Well, I think we're pretty much out of time here in terms of our time for the webinar. Thank you so much, everyone, for joining us, and a special thanks to Brad Long for being our guest speaker for today. We hope all of the conversation was helpful, and encourage you all to reach out to your local advisors with any additional questions or assistance that you need to navigate through your financial journey. Really appreciated the great questions that we got from the audience, and thank you again, Brad.
All right, thanks, Rafia. Appreciate it.